I made the choice to divest all of my shares in QYLD, an investment I initially made approximately 4 years ago. Despite the ETF's strong performance over the past year, I believed it was an opportune moment to sell and redirect my capital gains into a different, newly attractive ETF I've been monitoring for a couple of months. QYLD was my inaugural venture into covered call funds, but I've recognized the emergence of newer covered call funds with enhanced strategies since my initial investment, prompting my decision. In this discussion, we'll get into my experience with QYLD and the rationale behind my divestment, and outline my chosen avenue for reinvestment. Welcome to Financial Fluence. We share the latest ways to make money online, along with some helpful tips and tricks. Make sure to subscribe to the channel, like the video, and turn on the notifications to stay updated whenever I post new content. Upon encountering the Global X NASDAQ 100 Covered Call ETF, also known as QYLD, 4 years ago, I found myself immediately drawn to it for several compelling reasons. Foremost among these was its notably high dividend yield, consistently ranging between 11 and 12%, coupled with its monthly dividend distributions to shareholders. Another key factor that piqued my interest was its potential to generate dividends from an unconventional source, the technology sector. Given that the NASDAQ 100 index predominantly comprises tech companies, which typically prioritize growth over dividend payouts, the prospect of utilizing a covered call strategy on these stocks presented an intriguing opportunity to diversify my income sources within my portfolio. As far as my knowledge extends, the Global X exchange-traded funds were pioneers in employing the covered call investment strategy. This approach involves acquiring all the stocks in an index while simultaneously selling corresponding call options on that same index. Subsequent to my initial investment in QYLD, I also ventured into 2 other funds offered by Global X that adhere to the same strategic approach. I also diversified my investment portfolio by purchasing XYLD, which is Global X's S&P 500 Covered Call ETF, as well as RYLD, the Russell 2000 Covered Call Index Fund, sometime between 2020 and probably 2022. And during this time, QYLD experienced a surge in popularity, with many dividend investors on platforms like YouTube expressing interest in investing in this covered call fund. Consequently, it's reasonable to assume that other ETF providers took notice of QYLD's popularity and its covered call investment strategy. I believe that companies recognize the growing appeal of covered call funds and income investing, even among individuals who are not yet retired. I'm not retired, and I love income investing. In the past couple of years, we've witnessed the emergence of other companies introducing their own covered call funds, most of which employ strategies distinct from Global X's. Most notable include JP Morgan's introduction of JEPI in 2020 and JEPQ in 2022. Also, NEOS launched their own S&P 500 covered call fund with a unique strategy in mid-2022, ticker symbol SPYI. YieldMax has introduced more than 24 covered calls in the last 2 years alone. Smaller companies such as Crane Shares, Defiance, and Rex Shares also have entered the market with their own covered call funds. Even established names like Goldman Sachs and iShares have released their own covered call ETFs, signaling the enduring popularity and mainstream acceptance of these investment vehicles. However, since the inception of QYLD in 2013 and my initial investment in this ETF, newer similar ETFs have improved strategies that have been introduced to the market. These enhanced strategies offer better downside protection during market downturns and potentially higher yields with improved tax treatment in some cases. With these considerations in mind, I made the decision to sell all my holdings in QYLD, realizing a capital gain of over 15%. Subsequently, I reinvested those proceeds into a similar ETF that also employs a covered call strategy on the NASDAQ 100 index. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on that notification bell to be notified every time a new video is uploaded. Now let's get back to the video. This newly released fund, which I added to my portfolio about 2 months ago, holds significant promise for superior performance going forward. The latest addition to my holdings is QQQI, the NEOS NASDAQ 100 High Income ETF. Typically, I exercise caution before investing in a brand new asset, preferring to wait until it establishes a more consistent track record, usually spanning at least a year. But I made an exception in this case due to the striking similarities between QQQI and SPYI. QQQI essentially mirrors SPYI, with the only distinction being that QQQI focuses on the NASDAQ 100, while SPYI concentrates on the S&P 500. Comparing the two, QQI to QYLD, the NEOS fund offers superior downside protection during downturns in the NASDAQ 100. While both QQQI and QYLD will experience declines when the NASDAQ 100 falls, QQI's decline will be less pronounced due to its more robust covered call strategy. On the other hand, when the Nasdaq 100 performs well, QYLD's upside potential is limited, whereas QQQY stands to gain more in share price appreciation. This factor alone makes QQQI a preferable choice, just in my view. And since its launch, SPYI has consistently provided investors with a yield between 11 and 12%. And in contrast, the QQQI ETF has delivered a dividend yield of almost 14.5%, making it one of the highest yield investments in my portfolio. If QQQI behaves similarly to SPYI, having a diversified ETF with such a high yield is amazing. While there are other high yield options like some PIMCO funds like PDI, these often involve higher risk, making them not suitable for risk-averse investors. I'm optimistic that the NEOS fund will offer a much safer alternative. I'm invested in both QQI and SPYI. Additionally, QQQI boasts another advantage over QYLD in terms of tax efficiency, aiming to minimize tax implications for investors. So these factors make QQQI a compelling investment choice, and I anticipate it will outperform QYLD in the long run. Similar to SPYI, this new fund leverages Section 1256 contracts for tax-efficient returns. According to its prospectus, the fund utilizes index options that qualify as Section 1256 contracts under the IRS code. At the end of each tax year, these contracts are treated as if they were sold at fair market value. Gains or losses from this section contracts are then classified as 60% long-term and 40% short-term, regardless of the duration they were held. Remember, I'm just a guy on YouTube. Consult your CPA. Additionally, the fund may engage in tax loss harvesting by offsetting realized taxable gains with investment losses from certain equity and options positions. This tax-efficient approach, combined with its higher yield, increases upside potential and potential tax savings, making this new ETF a superior choice in my opinion. But it's essential to acknowledge potential risks associated with investing in this fund. While this isn't unique to QQI, one notable risk is the volatility of the Nasdaq 100 itself. Past instances, such as the tech sector crash in 2000, highlighted the index's susceptibility to significant bubbles and prolonged recovery periods. Compared to the S&P 500, which has not experienced a crash of similar magnitude, the Nasdaq 100's concentration of riskier tech stocks makes QQQI a riskier investment. Considering this, I may consider selling these holdings if the market becomes unfavorable. Regarding the question of holding both QQQI and JEPQ, while they both focus on Nasdaq tech stocks, they employ different investment strategies. QQQI targets a more stable share price and dividend, whereas JEPQ offers greater share price growth, but with a lower yield and more variation in dividend payments. Both ETFs complement each other in my portfolio, providing diversification and catering to different investment objectives. So depending on your goals, invest in the ones you want. If you love this video and found the content informative, please like and leave a comment below. We'd love to hear what you have to say. Are you invested in JEPQ, QYLD, or QQQI? If you enjoy similar stuff, check out my other videos. If you enjoy it, hit the like button, subscribe to the channel, turn on the notification bell, and I'll see you in the next video.